Ladies and gentlemen, boys and girls, children 18 plus. You are tuned in to the Loan Officer Podcast with me, Dustin Owen, and with me today in the office studio is Ben Davis. Ben, welcome to the show.
Good afternoon. How's everyone doing?
Well, they can't hear you nor respond, but I'll respond for them. Everyone is doing fantastic because we have the man, the myth, the legend. Ben Davis is a 20-year veteran of the mortgage industry. 21-year veteran. He's an I-dotter, a T-crosser. He runs one of the largest individual branches in the entire company. Last month, his branch produced, this is one single location, ladies and gentlemen, his branch produced $57 million in volume. That's out of Orlando, Florida. So it's not like we're up in the Silicon Valley where $57 million might have been 57 transactions. Average loan size in Orlando is about $235,000. Ben's individual branch, he and his 25 loan officers, $57 million, on pace to close over $500 million this year alone. And he's going to spend the next 25 minutes with us talking about self-employed borrowers. If you are a self-employed person, no one needs to tell you how difficult the past 6 months have been, as COVID has either impacted your business in an extremely negative way, and for some, it's actually impacted your business in an extremely positive way. But with COVID, with the fallout, and because you're self-employed, it has become increasingly difficult to obtain home loan financing. If you're a loan officer, you don't need me or Ben to remind you what it's been like the past 5 or 6 months trying to help assist your clients who are self-employed with obtaining their home loan finance. But what I want to do is I want to get the person that I know as the best at understanding programs, guidelines, how to work within them and get loans closed, to talk specifically, if you're self-employed, how you can obtain a home loan, why things are the way they are, and if you're a loan officer, some tips, tricks, and takeaways to make sure that you're doing the best job up front for your self-employed clients. So Ben, I don't know where you want to start with this. If you want to start with what it's like to be self-employed and obtain a home loan in today's post-COVID industry, or if you want to speak specifically to the loan officers first, I'll let you dictate the path we take.
Okay, well, certainly, thank you very much for the most humbling introduction. So self-employed borrowers, obviously, is a hot topic today in mortgage lending. Historically, Fannie and Freddie, the agencies, have considered a self-employed borrower a slightly greater risk in a lending transaction than a traditionally employed borrower. As such, we had a curveball thrown at us about 6 months ago. That was COVID-19. So Fannie and Freddie have adopted and put in several additional criteria that has to be met due to the current COVID environment and potential decline in income from the self-employed borrower.
And real quick, for our listeners, Fannie and Freddie is basically the two government or quasi-government institutions that regulate conventional mortgage financing. Some other ones would be the Department of Veteran Affairs if you're a veteran applying for a VA loan, or HUD if you're obtaining an FHA loan. But HUD and VA, I believe, are going to follow pretty similar guidelines for self-employed people when it comes to how we document and qualify them, correct?
Yeah, correct,
okay.
100%. So the majority of residential lenders out there, they're going to take their directive from Fannie and Freddie, and then the other sub-agencies are going to follow suit. So, like I said, going back to the, according to Fannie and Freddie and the other investors, the inherent potential risky nature of a self-employed borrower, what they would be most concerned with today, and due to the current economic environment, is, what is the self-employed borrower's present day income? And how does that present day income compare to their historical numbers, right? So obviously their present day income could be equal to or better, or it could be worse, So I think where some of the confusion and perhaps some of the reluctancy from a salesperson to want to dive deep and speak and try to get a self-employed loan done today is, they make the false assumption that if the self-employed borrower's income has declined, then they're automatically going to have a loan declination accompany that decline in income. But the reality of it is Fannie and Freddie have been pretty specific. They've rolled out their waterfall, things that you need to gather, things that you need to review, things that you need to consider. And even with a decline in present day income, as long as the lender can support and make a clear case that the income has stabilized and it's upward trending, then it can still be utilized. So I would say for most self-employed borrowers, the loan officer needs to start with, hey, tell me how it's going today. Just get a conversation going. What I like to say is get the juices flowing, and then from there you can often at least have a warm and fuzzy on whether or not that if we take it to the next step, collecting the present day documentation, collecting the historical documentation, what that's going to look like. As an example, say that you're talking to someone that tells you that they own their own construction company. You ask them, how's business today? And their response may be, it's gangbusters, right? Today, we're doing better than we've ever done in the past. I know through experience and talking with other people that are in the construction business that their present income is better today than it has been in the past.
So that's a self-employed buyer, home buyer.
Correct.
That you're not going to be concerned that the new COVID rules are going to make financing more difficult for them. In fact, they're going to fly through with ease because they can prove that their income is actually greater or better post-COVID than what it was pre-COVID.
Correct.
But if I owned maybe a bar or a restaurant or a nail salon, that might not be the same situation. I may very well have a more difficult time obtaining a home loan, or I won't be able to obtain one at all if my income has declined to the degree that I no longer can prove I can substantiate the new mortgage payment.
Yeah, 100%. Like I said, I just like, an opening question to a self-employed borrower. I've changed my script today as compared to what it would have been in the past. And I feel like an initial good question to a self-employed borrower is, how's your business doing today? And to your point, that's going to lead us down the path of, this is what I do for a living. I'm in a certain category of the economy that either has done better, stayed the same, or done worse. And then from there, you kind of get into the documentation. So,
and I think I heard you say just because you're doing worse is not a massive red stop sign.
Correct.
It's a proceed with caution.
Yes, 100%.
Okay, and I think that's good to know because there's a lot of misconceptions, especially when I talk to self-employed borrowers. They'll call in and they'll say, "Oh, I'm self-employed. I heard I can't get a loan." I'm like, "Well, what are you talking about?" And to your suggestion, you have to ask them, "Well, what do you mean by that? What do you do for a living? What type of business do you operate? And is your business better today than it was 6 months ago? If so, then we proceed ahead. If the answer is no, it's okay. Well, let's slow down and dig a little deeper. When we dig a little deeper, what type of digging is Fannie Mae and Freddie Mac or FHA or VA? What type of digging are they going to ask of us, but then more importantly, our self-employed borrowers or buyers, our clients?"
Yeah. So Fannie Mae will instruct lenders, and Freddie Mac also will instruct their lenders on how they should be underwriting loans with something called a lender letter. Okay. So if you Google Fannie Mae COVID-19 lender letter, it's going to provide you with the documentation that's required today for a residential lender to review a self-employed borrower's income.
And
right?
everyone who has access to Google will have access to this letter.
100%.
You do not have to be a mortgage loan originator. You do not have to be a mortgage broker, a lender, a bank. You and everyone else who has access to Google will have access to this lender letter.
Yes.
Okay.
100%. Even Jeff Bezos, if he has access to Google, or some other person like that. So yeah, to get to, what are the requirements? Okay. So bullet point 1, it says that the self-employed borrower needs to provide an audited year-to-date profit and loss or an unaudited profit and loss along with the most recent 3-month business bank statements.
And this is so that we can verify and document whether or not our income has gone up, gone down, or stayed the same since COVID.
Correct.
And by the way, last time I checked, go up, go down, or stay the same, only one of those is bad.
Correct.
Stay the same and go up should be a good thing.
Yes.
If income has dropped, that's when we're going to dig a little bit deeper. And when we dig a little bit deeper, what is it that they're looking for on those bank statements or on that audited profit and loss statement?
Mm-hmm. Okay. Well, so again, to clarify, a misconception out there is what an audited profit and loss is. Okay. I can tell you that an audited profit and loss is the pink unicorn. I mean, it may exist, but I've never seen one. And let me tell you why. So, for any CPA to audit a financial document, they have to have that auditor's designation, right? So that's additional training, that's additional continuing education that they have to do. As a result of those additional training and education requirements that the CPA has to meet, don't you think that's a cost that they pass along to their client? Of course it is. So right off the bat, when I see Fannie and Freddie's directive and their options, I can use an audited P&L or an unaudited P&L along with the 3-month business bank statements. I'm already going to unaudited P&L from the borrower, from the tax preparer, and 3-month business bank statements. The audited P&L, although it is an option, is probably something you're not going to utilize. It's probably something that's not cost effective for the borrower because they're not going to spend $5,000 and waste and take the accountant's time to prepare one. So cost prohibitive, time prohibitive. So I think the most likely thing that you're going to request and review from the borrower is an unaudited P&L. It can be prepared by the borrower, their office manager or their tax preparer, and their most recent 3-month business bank statements. So to start with, what are you looking at, right?
Yes.
So if that's going to be the most commonly requested and reviewed information from the borrower, you need that along with your traditional documentation, right? To your tax returns, to your W-2s, pay stubs if applicable, okay? So
K1s if you have an S Corp, your
K1s,
2 years of your 1120S, like you still need the whole kit and caboodle.
Correct.
But now it's the whole kit and caboodle plus 3 months of business bank statements, where prior to COVID, it was very rare that any lender or bank was asking for 3 months of business bank statements.
Correct.
Or a
year-to-date P&L.
Or a year-to-date P&L. Correct.
Yeah,
okay.
Correct, 100%. So it's the same standard and typical documentation plus this additional COVID-19 requirement. Year-to-date P&L, 3-month business bank statements. So what I would do, the very first thing that I would look at is, let's just use the simple example of a borrower that's 100% owner of an S Corp, okay? So they're 100% owner of an S corporation. I review their 2019 business tax return. I go right to the top line, right, which is revenue, gross receipt, whatever you want to call it, okay? So the business last year, let's use an easy number, brought in top line revenue $480,000, right?
Okay.
$480,000 is
$40,000 a month.
$40,000
For anyone at home playing along.
Okay, good. So easy, right? I'm from Alabama. I have to use, short and simple numbers so nothing gets too confusing. $40,000 a month is what our historical average monthly revenue was, right? So I want to compare my historical average monthly revenue number to my present day 3-month average revenue number, okay? So a 3-month business bank statement review period, if we're in September, would most likely be for June, July, and August, correct?
And we're looking for each month, my guess, using simple Alabama math,
There you go.
I'm looking for $40,000 of deposits?
Deposits.
Average, okay.
Over the 3-month period, right? So sidebar, let's talk about the COVID time frame and PPP and what those things were. So
from what I hear, we're not down with PPP.
We're not down with PPP. Well, there's a lot of self-employed borrowers that are, okay?
Yes.
Yeah. So PPP was the grant money that the government offered self-employed, not self-employed borrowers, but self-employed business owners, right, to maintain their payroll. So my understanding, and correct me if I'm wrong, you may know more about it than I do, is, the money was given, it was based on historical profitability or historical revenue, and the caveat was, we're going to give you this money, and as long as you're using it to maintain payroll, maintain your employees, right, then at some point in the future it's going to turn into a grant, the money's forgiven, right? If it's used for any other purpose than that, it turns into a loan and then it has repayment.
Like I need to go out and buy supplies,
Correct.
I need to pay rent, I need to pay my loan.
Yeah.
And that's my understanding as well of the PPP. And what I've seen firsthand, and I think you can speak on it in greater detail, I've seen some people who are self-employed, they're small business owners, they received the PPP, and it's fantastic that they did because that's what is helping keep them afloat. But their PPP over the last 90 days was the bulk of their deposits.
And that's the point I'm trying to establish is because we're in September, our most recent 3-month review period is only going to be June, July, and August. However, the PPP money was given to the business owner typically in April or May, okay? So that money, if it was received, it may be outside of our review period. However, it's probably going to show on the P&L, right? So you don't want to be so laser focused on just reviewing the bank statement or just reviewing the P&L and not kind of putting them together and looking at the whole picture, you know.
Because Fannie Mae and Freddie Mac, just for the record and for clarity purposes, we can't use that PPP to help a home buyer who is self-employed qualify for financing.
Correct.
It's fantastic the government gave it to them.
Correct.
But we still can't use that to help someone qualify. So one way or the other, it needs to be backed out.
Yes.
Okay.
Yeah, because specifically Fannie and Freddie says that it can't be used for funds to close, nor can it be used for income, right? So to your point, it has to be backed out, okay? It doesn't, so let's look at I think what you were asking earlier is, you know, I have my 3-month business bank statements. I'm looking at deposits, right, to see what my average monthly deposits have been, and I'm comparing that number to what my historical revenues were.
Yeah,
right?
the number we were using was 40,000.
40,000.
And as an originator, if I saw last year's tax returns, your top line, as you call it, showed that your gross receipts or your gross revenue, gross is the big number, by the way, the gross was $480,000 or $40,000 a month on average. I'm hoping, fingers crossed, that when you submit your June, July, and August bank statements, that amongst those June, July bank statements, it's going to be somewhere between $30,000 and $50,000 a month in deposits going into your bank statement, because that is going to be my case to go to the underwriter and say, see, my particular client is not being negatively impacted by COVID. Is that the right and proper thought process?
Yeah, 100%. I mean,
But oh, go ahead.
No, I would say, yeah, that's definitely step one, right? I mean, and you can't, I think what's important, and something I kind of talked about earlier is, you know, it's not just the bank statements, it's not just the P&L, and it's not just step one. You know, you've got to take it a step further, you know. So 100%, if you've reviewed those 3-month business bank statements, you're coming up with something close to a historical number, right? I'm feeling good. I've got some positive energy. The next thing I probably want to look at is, let's forget whatever the beginning balance and whatever the ending balance was shown on the bank statement. We took the deposit number, right? And we can also see the withdrawal number, right? All of that should be right there at the top of the bank statement, right? So our deposits for the month of June were $43,000. The withdrawals during that same period were $38,000, as an example, right? So in that case, the business had positive cash flow for that 1-month review period. Agreed? Right?
Yes.
So
Yep.
I would do the same thing for the next month, for July. I would do the same thing for August. Okay. So again, just cursory, high level, trying to create comfort, trying to create some good feelings here. If I've got deposits that mirror a historical average, I've got positive cash flow for the 3-month review, man, I'm feeling pretty good. Okay. Let's assume, and this may very well be the case, that you don't have positive cash flow for one of those months,
Okay.
or even for all 3 of those months.
Or, and maybe I'm getting ahead of myself here, but what happens when 40 was our number, but when we look, we only see 15 or we only see 20?
Taken out as withdrawal?
No, deposits. Or am I getting a step ahead?
Well, so, no, I think the example you may be wanting to use is there were $40,000 in deposits, but $55,000 in withdrawal. Is that?
No, I was actually thinking we're looking at historic numbers. Historically, our number that we established was $480,000 for the year, $40,000 a month. I, as the loan originator or the banker, asked my client to submit 3 months of bank statements, and when I received them, I wasn't seeing $40,000 a month in deposits. I was only seeing 10 or 15 or 20,000. So I might be getting ahead of myself because I think you were still wanting to explain to us, which is going to be needed and warranted, what happens when you see 40, and 40 is the number that we were aiming for, but 40 was what was being deposited, but what was going out was much larger, like 50,000.
Yeah, correct. So, and yeah, we'll circle back on if the deposits were less than historical numbers.
Okay, yeah. So we'll come back to that, but let's finish the original thought.
Yes. So we started with what is best case scenario, right? That your present day average deposits mirror or they exceed the historical number, right? So that's step one. That's probably best case scenario. Second best case scenario would be when you're reviewing the withdrawal amounts for those periods that the withdrawal amounts didn't exceed the deposits, right? Which means you had positive cash flow. And then the third most likely occurrence, and what I would call third best case scenario, would be you have a good deposit number, but your withdrawals do exceed your deposits, okay? So you have some cash flow negative, okay? So then it gets into what does the business do, right? Think about it. If the person is a home builder, their deposits and their expenses aren't always going to match up.
Correct.
Right?
Because as a home builder, I have a significant cash outlay to get the home built and completed.
Yes.
I don't achieve my profits until the home buyer has closed on their financing and moved in.
Okay. Yes, great example. So think about this. Home builder, he's showing, equal to or even slightly less historical deposits. He has withdrawals that exceed deposits, okay? Does it mean that we don't have a deal? Not necessarily, okay? Because if I know that he has a home that's scheduled to be completed a month from now or 2 months from now, potentially it's under contract, that's additional information that I can provide and help get the underwriter comfortable with, if their current present day income is stable, although it may have declined, it's still stable, right? And there is a continuance at some point in the future.
So here I am, I'm listening to you go, and it's impressive, which is why I begged you to come on the show and do this topic with us. But B, my head's spinning. And my head's spinning, and I do this for a living.
Yeah.
I mean, to me, as I listen to you talk, this is every reason why home buyers, especially if you're self-employed, or realtors and builders, when your clients are self-employed, that they have to speak to a proven professional expert who knows what they're talking about. Doesn't have to be Ben Davis, doesn't have to be someone at Waterstone, just has to be someone that they know what they're talking about, because it sounds like there's a lot of details, a lot of moving parts, and some of it's subjective or some of it's up in the air.
Yeah, certainly.
And if the originator doesn't know what to ask, then they don't know how best to tell the story to the underwriter in order for the underwriter to see the borrower in the best light. So let's do this. What happens if, because I heard all of that, and here's what I heard. So you're saying there's a chance. If you're saying there's a chance is what a lot of self-employed people just need to hear. But they also need to know the dark side, right? And the dark side is if you are used to achieving $40,000 on average monthly in gross revenue, and you're trying to obtain a home loan post-COVID, and you give your banker, your lender, or your broker a bank statement that shows $10,000 a month, it more than likely would be a dead deal. Is that a fair assessment?
Yeah. Well, but again, like you said, it really depends. I can give you kind of like. Let me answer the question with a completely different scenario.
Okay, perfect.
But similar. Okay. So what your example was our review period over 3 months shows deposits that are way lower than historical.
Yes.
Right. Something we've run into lately are accountants, right? I'm a 100% owner of an S corp, and I'm a tax preparer. Okay, think about what happened this year, right? The tax filing deadline was moved from April the 15th to July the 15th.
And I know that because I filed my taxes on July 14th.
There you go. All right. and when do accountants realize the bulk of their revenue during the year?
Right after tax season.
Right after tax season, okay? So I've done this recently. We've reviewed accountants that are self-employed that want to borrow money to buy a home, right? We look at their 3-month business bank statements, and they look great. But there's more to the story. You have to understand, when did those revenues get the reason that it looks so good is because that's what you would have expected to happen, but earlier in the year in a normal environment. If all of that makes sense.
Yeah, they work in a profession, at which point, kind of like if I'm a wedding photographer or I'm a limousine company or so many other cyclical and seasonal professions, I may see 70% of my income in 3 months.
Correct.
And those 3 months could coincide to benefit me. Like in the example of the accountant, it made the accountant look maybe stronger than they were on paper.
Right, and that could give the loan officer a false sense of security if they haven't taken it the step further. To your point earlier, you don't want to just automatically, decline a loan or turn down a loan at point of sale based solely on the fact of the 3-month review period, because although Fannie and Freddie are only requiring the lender to do a 3-month review period, right? If I have a borrower that we need to introduce the first 6 months of the year, if we need to introduce, their pipeline, right? Because their pipeline is going to be closing next month and the following months, all of those things. I mean, nothing is off limits. It's kind of like what you said earlier. It's just really diving deep, telling the story, and creating a level of comfort and believing. I would say believing in what you're fighting for, right? Because if you can't get behind it and the borrower can't get behind it, the underwriter is going to see through that, and I think you're probably setting yourself up for failure.
Well, it's funny. That reminds me of one of the first things you and I were taught when we were both young when we entered this industry. But one of the first things you're taught is, would you lend this person your money?
Correct.
Like that's a question just to ask yourself if you're an originator. Heck, even if you're a borrower, would I lend someone like me money, my own money? If the answer is yes, then you should be able to. A point you're making is you need to figure out the question behind the question in order to prevent yourself from falling into a trap of false securities. And the false security could be, oh, things look fantastic. I'm going to move forward with a mortgage pre-approval. Later down the road, once discovery has been done by processing and underwriting, you realize it doesn't meet industry guidelines, or the exact opposite could happen where you just look at a snippet, you say no. But if you asked the question behind the question, if you fully understood, and the term you use is interview, you interviewed your client, or you as the client allowed yourself to be interviewed, because sometimes as people we're naturally a little apprehensive to share our story and share information. But if you're applying for a home loan, you need to understand if you are the consumer, the more your loan officer knows, the better. The more you tell your loan officer, the better advocate they can be for you. And as a loan officer, don't stay surface level, especially with your self-employed borrowers. We could talk for literally hours and hours and hours, especially as it pertains to guidelines and programs and products for just self-employed borrowers. But how about this for time constraint purposes? What are 2 or 3 recommendations you have for anyone who is self-employed looking to obtain a home loan while these guidelines are still in place? So this is for the home buyer, not yet our loan officer.
For a home buyer, I would say first and foremost, go ahead and put together a year-to-date profit and loss, right? And be thorough in your analysis, and like you said up front, just go ahead and put it all out on the table. If you receive the PPP money, include that in your P&L, right? It doesn't mean that we can't do a loan for you. We just can't consider it. And there's still plenty of borrowers that are getting loans today that receive PPP money because they're able to qualify without the inclusion of that money.
And I think it's good to know that I want to summarize too, as you think of your third takeaway for the client, just because you receive PPP doesn't mean that we can't do a loan for you. And just because your income has declined doesn't mean that we can't do a loan for you. Both those items, though, just happen to be additional hurdles, or let's call them yellow flags, warning flags,
Correct.
that we're going to have to obtain more information on. So please don't hold it against your bank, your lender, your mortgage broker, that they're wanting to dive deeper. Just know they're doing their job, doing their due diligence in order to make sure that the information they share with you is indeed the most accurate information. How about a last good tie down or takeaway for someone self-employed looking to purchase a home and finance it?
Yeah, I mean, I think you hit the nail on the head earlier. It's, the loan officer is taught, would they lend their own money to the borrower, and the borrower should have the most wherewithal, because they know their business better than we do. Do they feel that it is a prudent time to purchase a home? And to give you an example, we pulled a report last month, and I think company-wide we had a little over 8% of our loans in process loan requests in process were from self-employed borrowers.
Okay.
Right? Now, to be honest with you, I don't know how that 8% number compares to a historical number, but I'll almost guarantee you that it's lower today, right, than it has been in the past. And the reason being is because, for people that aren't comfortable about the future because their business has declined or they see it declining, they're less likely to make a loan request, right? If you feel confident about today and you feel confident about the future, well, then just make sure that you can describe that to the loan officer that's going to be your advocate, to the underwriter. It's done by preparing the year-to-date profit and loss, being forthcoming with your information, putting it all out on paper, and then understanding that, yes, you're going to get asked more questions today than you've ever been asked in your life, and when you're asked the questions, understand why you're being asked, give a lot of information, give a lot of good information, and I mean, I would almost say where there's a will, there's a way,
No, I love that. How about for the loan officers? I mean, you are fortunate that you surround yourself by 25 of the most competent loan officers who help do tremendous numbers and help hundreds of families every month obtain financing for their home purchases or their refinances. What are you teaching your loan officers right now to do when it comes to how to best assist a borrower, client, buyer, home buyer who is self-employed?
Yeah. Well, number one, first and foremost, if you don't have to introduce the self-employed income to the transaction, don't, okay? So as an example, we do loans for married couples all the time. Oftentimes there's a wage earner that can qualify for the loan based on their own income alone. And if that's the path of least resistance and it's going to make everyone happier, perhaps take that path, So that's something that we're doing a lot now, is we're kind of walking the married couple through. Here's going to be the documentation requirements. And, oh, by the way, we can avoid all of this because, lucky for you, your spouse isn't self-employed. She or he earns enough income to qualify for the loan on their own, so we can avoid a lot of this. So I would say, first and foremost, do you need to include this analysis?
Yes. Okay.
Do you even need to include this analysis? Because we get so excited and so energized by what's new and cool and sexy. Right now, everybody wants to almost review self-employed income. And I'm like, crap, man, if you don't have to review it, don't do it. Because we have done that recently. We've literally made it easy for us. We've made it easy for the borrower. We've made it easy for the underwriter and the realtor. Number two is, it's just do a very thorough interview. Be prepared to tell a good story. Our regional underwriting director, something I stole from her, and I love it, and I preach to all of my loan officers. She says, tell me what you want me to see. Don't make me go find it, right? So just
paint the prettiest picture.
Correct, yes. To put it all out there, tell the story, and the longer and the more thorough the story is, typically the better result you're going to get.
Fantastic. And something to keep in mind also, look, COVID wasn't on us. We didn't create it. We didn't ask for it. Fannie Mae and Freddie Mac's new guidelines, they weren't on us to create, but we all have to live by them. Something to keep in mind that I've found as well is we tend to not introduce co-signers in certain transactions because our brain doesn't go there. Someone who's owned their own business for 12 years and maybe they have grown children, maybe they're 20, 25 years into their career, they think of a cosigner as, oh, that's what I used when I was fresh out of college to buy my first home. Well, look, we're living in unique times. Don't get so short-sighted that you forget that you could potentially introduce a cosigner.
Certainly.
And even if you did the cosigner to get you through the first couple years, and if you wanted to refinance that cosigner off in 2 or 3 years because you're confident rates are going to stay low, then you could always do that. But I think as an originator, I sometimes won't look that way because mentally I think, oh, cosigners are for younger people, younger in their careers, younger in their life. But it's something that we could be using some more. Ben, I totally appreciate all of your time today. Thank you for doing a deep dive on self-employed, I call it qualifying self-employed buyers in a post-COVID world. He's Ben Davis. I'm Dustin Owen. We both work at Waterstone Mortgage. You can find him on Google, Ben Davis. You can find me at 407-645-6363. Facebook, Instagram, at The Loan Officer Podcast, YouTube, at The Loan Officer Podcast, 407-645-6363. That is it. We are done. Peace.